Hello everyone, I am Dr. A. Nagalakshmi, Assistant Professor, Department of Commerce with Finance in Dr. SNS Rajalakshmi College of Arts and Science, Autonomous, Coimbatore. Now I am going to explain a concept in the course Corporate Accounting in the unit preference shares, that is issue of preference shares and related concepts. Um, as I that is Issue of shares. I told you, I have explained already what is meant by a share. Share is nothing but it is one unit of the total capital of the company if it is issued to the public. If the company is inviting the public to receive the shares of the company, and one part, that is one unit of the total share capital, is said to be a share. So, share represents ownership units in a company forming part of its share capital. They are issued to raise funds for business operations, expansion, or other financial. It may be any reasons. If the company needs funds, they will be opting the option of shares, issuance of shares. Now we are going to see the issuance of preference shares. First, we should know what are the types of shares. We have equity share, preference shares. Equity shares means ownership. The shares will have ownership, voting rights, and the holders receive dividends based on profits but not a fixed return. They bear higher risk but have a potential for higher returns. They are said to be the owners. The owners cannot take a fixed percentage. If the owner gets more profit, more dividend will be paid to the equity shareholders. But preference shares, vice versa, carry preferential rights to dividend and capital repayment during liquidation. They are usually have fixed dividend rate and limited voting rights. Sometimes they won't have voting rights. Only the equity shareholders might have voting rights. Now we are going to see the process of issuing shares. First, authorization. The company's articles of association must permit the issuance of shares, and approval is required via a board resolution or shareholders resolution as per Companies Act 2013 section 62. So authorization is the first process. Without the authorization, if nothing is mentioned in the article, shares cannot be issued. Second one is prospectus issuance. So a prospectus is nothing but it is an offer document issued to invite the subscription from the public or private investors. See, if I am going to issue a shares, I have to invite by giving a document. In that document, the whole detail, that is all the details of the company has to be mentioned. Only the truth has to be mentioned, actual has to be mentioned. Then the investor or the shareholders who are interested can, if they get satisfied with that offer document, that is prospectus, they will go for purchasing the shares. Next is application and allotment, third process. That is, investors apply for shares. The company allots shares after receiving applications and payments. The fourth one is share certificate issuance after. See, for example, if 1 lakh shares are issued at a rate of 10 rupees, if all the 1 lakh shares are applied by the public and allotment has been made, means share certificate is to be issued to them. Share certificate are issued to the allotters within 30 days. And the details are recorded in the register of members according to Companies Act 2013, section 56. Next is pricing. So pricing is nothing but the issue of shares at what rate. Pricing is at par, at a premium, at a discount. At par means same value, issuance value. Premium means extra. That is, what is the face value? More than that. Discount means what is the face value? Less than that. Next is accounting treatment for issue of shares at par. Bank account data to share capital account. Issue at a premium, bank account data to share capital account to share premium account. On issue at discount means bank account data, discount on issue of shares account data to share capital account. There are key points relating to this. Shares can be issued for cash or consideration other than cash. For example, if I am purchasing a machinery or if I am purchasing a building for the business, some amount may be paid in cash and the remaining amount I can settle them by issuing the fully paid up shares. That is said to be shares can be issued for cash or other than, that is, or consideration other than cash. Next, securities. The Securities and the Exchange Board of India, that is SEBI, regulates the public issuance to protect shareholders, that is protect the investors. The next one, issue and redemption of preference shares. Now we are coming to the main climax. Definition. So preference shares are hybrid securities with fixed dividend and priority over equity shareholders for dividend payments and capital repayment during liquidation. They are redeemable with a maximum period of 20 years as per Companies Act 2013. Section 55. So preference shares are hybrid securities. Hybrid securities, it contains fixed dividend and and priority over shareholders for dividend payment and capital repayment during liquidation. Now we should know what is the types of preference shares: cumulative, non-cumulative, redeemable, irredeemable, convertible, non-convertible, participating, non-participating. These are the types. Now we can see the issuance. So condition is issuance of preference shares comes under section 55 of Companies Act 2013. It should be authorized by articles of association, approved by a special resolution at a general meeting. No default in existing preference share redemption or dividend payments. Accounting treatment is bank account debtor to preference share capital account to securities premium account. Now redemption. Redemption means getting back the shares after a fixed period by the company. The condition, only fully paid up preference shares can be redeemed. Redemption can be funded from, that is, redemption means while getting back the shares from the shareholders, the amount has to be settled to the shareholders. So profit available for dividends transferred to capital redemption reserve, proceeds from a fresh issue of shares, CRR. CRR is nothing but capital redemption reserve is created by transferring an amount equal to the nominal value of the redeemed shares from profit. So a part of one portion of the profit will be always holded by the company for the situation like redemption. Methods of redemption. Redemption from profit. Redemption through fresh issue. Redemption from capital. So we have three methods of redemption. One is redemption from profit. Profit means a portion of the profit is kept for redemption. It will be transferred to capital redemption reserve. So which funds redemption without depleting working capital. Without touching any working capital, the amount will be redeemed. Next is redemption through fresh issue. Fresh issue means the company will make fresh issue of shares for redemption. That is, that corpus is created for making the redemption. Next is redemption from capital. Rarely used due to legal constraints involve using company's capital directly. Company's capital will be used sometimes. It's a rare occasion for redemption. Thank you. Thank you so much for the patience listening.